Joined by Macquarie Securities strategist Daniel McCormack. Thank you so much for joining us on the program. Give me your overview first of all, Daniel, because it seems that a lot of investors are actually spooked about what they're seeing in the European debt crisis. You think that there's still a lot of potential for these equity markets to increase. Why?
Yeah, certainly. I think medium term, there's no doubt that European equity is a very good value. If you put in what I would consider to be quite reasonable, even conservative assumptions for earnings and the multiple going forward, the maths gives you quite a bit of upside to European equities on a sort of 12, 18, 24-month type time horizon.
And this is despite, though, the two great unknowns, this economic cycle, we don't really know what we're facing in terms of recession, and the European debt crisis, we may see a default.
Yeah, so these are two near-term overhangs, I think, on the market. And, you know, to be pound-the-table bullish right now, I think you need to wait for at least one of those to clear. So there may not necessarily be a near-term catalyst, but I think medium-term, there's clear value there.
And so medium term is what, 6 months? So would you say let's wait until the end of this year to understand more on whether one of these overhangs actually materializes and then investors can go in?
Sure, I don't think you can put a fixed time frame on it. It's, you know, you'll know it when you see it. So the kind of things that we'd be looking for would be, you know, very clear forceful action from the ECB, some kind of commitment to cap yields perhaps, and then in terms of the economic cycle, things like the PMIs troughing, earnings revisions troughing, these kind of things.
And that would explain, actually, you expect a rally on equities of about 17%. If we don't get ECB intervention, what happens to your forecast?
I guess it would push it out more. So it would mean that if you don't have ECB intervention, you know, the sovereign crisis goes on for longer, the economic crisis will probably be worse, the recovery in earnings will be delayed, and so, you know, you'll eventually get a reasonable amount of upside, but it may be more an 18-month type time horizon rather than 12.
But so overall, what are you telling actually your clients? Don't panic, stay put with your positionings?
Yeah, and I think it's a case of what beta you want right now. So, you know, I don't think you want financials because of the sovereign crisis concerns, but I think the commodity space, materials and energy, looks excellent. So it's about the type of beta, I think.
Cole was just mentioning HSBC there, and this is actually one of your favourite picks.
Yeah, no, that's right. I mean, as I said before, I mean, we definitely have a preference for the non-continental banks, the UK banks, and the Nordic banks. Apologies. And the reason is simple. I mean, the funding pressures are less there. The credit crunch is likely to be less pronounced there. They don't suffer from the same kind of write-downs that the continental banks are going to. So it's a very obvious low beta play in a sector that looks problematic in the near term.
And actually, the other stock that you like within the banking sector is SWEDBANK. Now, this is also just because, what, it's less exposed to the European debt crisis.
Yeah, exactly. I mean, the Nordics have also been a nice little haven in this storm. Again, less pressure on their funding, less pressure on their balance sheets generally, so we like those as well.
Are you not concerned, though, Dan, that we're actually going to see a credit crunch? Again, that warning from Fitch, and overall, things aren't looking good. If we don't deal with the European debt crisis, are we going to see a credit event similar to Lehman Brothers? And do we really risk seeing the money markets freeze up completely once again?
Yeah, I don't think we'll see a Lehman-type event, but there's no doubt we are going through a credit crunch now. Banks will deleverage going into mid-next year, and that has obvious implications for the economy. So the economy is going to get hit, and a recession in Europe is highly likely.
And in terms of what we're seeing going forward, again, is there a turning point? I know it's very difficult to give investors and your clients a timetable.
Yeah.
But with the banking crisis, if it doesn't get worse by, what, the next 2 quarters, do you think we'll be out of the woods?
I guess, again, it's sort of a know it when you see it, hopefully, that the crisis ends. You know, if the central bank, the ECB, or politicians don't do something very serious about it very soon, you know, it could get nasty and could drag out quite a bit longer.
All right. Well, I wanted to get to you in terms of what China's been doing. It's been buying up more treasury bonds in the last, I think, 1 or 2 years. Now, this is because it's basically looking for safety havens, I guess, like any other investors.
Sure.
But does it also mean that its position is strengthening? I know you're looking at a lot of the mining and basic resources, and as long as China stays strong, then you're safe in these assets.
Yeah, I mean, I think the energy and materials sectors look really good for Europe. And there's an obvious near-term catalyst, which is China easing. Now, a lot of people think that the China construction data is what drives that sector, but actually, if you look at it back through history, it's not. China policy makes much more of a difference to those sectors' relative performance. So it looks now like China's easing, and in fact it has started to ease. There's little dribs of credit being provided to SMEs, etc. And we expect that process to accelerate going forward as inflation continues to fall and concerns about growth maybe grow as well in the near term. So that is actually positive for the relative performance of the commodity sectors.
And so that means actually you like Rio Tinto and BHP Billiton. Is there no concern about overproduction or a glut in production if we see a worldwide recession?
We're not overly concerned about it? No. I mean, we do like those two stocks. We prefer the big diversified miners with exposure to the bulk, so iron ore and coal, because they are your emerging market play. You know, base metals, a reasonable proportion of demand for base metals still comes from the developed world, where there are obviously more concerns about the economic cycle, but for the bulks, we think they look good.
Daniel, overall, I mean, China, we heard from President Obama some very tough words over the last couple of days on China, saying they really need to do more. Enough is enough in terms of the currency. We also see it, China buying treasuries but not buying Europe, which was a big hope here, that China would come to the rescue with their flag and, you know, their Superman outfit. This is not going to happen unless they really see a good deal.
Yeah, it looks unlikely, unfortunately. I mean, the Europeans were very much hoping for some money from China, I think. But, you know, all the news flow that we get from our guys on the ground in China is that, you know, they would like to do it perhaps through the IMF or perhaps through some kind of combined package. But going in on their own looks unlikely, which is, you know, is obviously not good news for Europe. Because
basically China just wants to make sure, we were talking about political clout and what they would ask in return, but they just basically want to make sure that their investment is safe. And at the moment, we don't know where Europe is headed.
Yeah, I mean, they're investors like everybody else, and they have dipped into developed world investments before, i.e. risky ones, and it hasn't really worked too well for them. So I think that means that they're just a little bit cautious this time around, and you know, that they don't want to throw just good money after bad kind of things.
All right, Daniel, thank you so much. Great to have you on. Daniel McCormack there, strategist at Macquarie Securities.